Thank you, everybody, for being here this evening. Go ahead and call roll. Vice Mayor Philseth, Councilmember Koo, Chair Scharf, and Councilmember Tanaka. 4 present.
All right. And do we have any oral communications? Nope, seeing none. And our first item is Utilities Advisory Commission recommendation that the City Council adopt a resolution adopting a hydroelectric rate adjustment. We have a staff report.
Yes, thank you, Mr. Chair, members of the committee. If I might just give the layperson's introduction to the topic. When we talk about hydroelectric and many of our utilities, we can very quickly dive into the technical details. So in the broadest sense, what we're talking about is automating an adjustment to rates that historically the council has had to do on a case-by-case basis. So this will provide some predictability in the methodology and the timing for adjustments that might be warranted to our electric rates based upon what's happening with the snowpack ultimately impacting our hydroelectric supply. On the topic of whether and the extent to which hydroelectric represents a large portion of our electric portfolio, currently hydro represents about 50% on a typical year of our electric supply resources. The council will be seeing later this calendar year a review of a going forward strategy for the proportion and some of our strategies around negotiating for the share of our portfolio that comes from hydroelectric. So there will be some upcoming discussions, but again here what we're talking about is a relatively straightforward mechanism for addressing water supply issues as it affects our electric. So with that, Jim Stack, our Senior Resource Planner, will report for staff.
Great. Yeah, thank you for that great introduction. Good evening, council members. So that kind of covered most of what I'll be talking about tonight, but I'll give you a little more detail. I'll talk a little bit more about the background of the issue that we're addressing. I'll cover 4 of the options that we've analyzed for how to address the issue. I'll talk about our recommended strategy and the implementation of that, how it would work in the real world, and then get some questions and feedback from you if you have any. So with that, as I just mentioned, the western-based resource and Calaveras reserves provide on an average year about half of our electric supply, which is a higher concentration than the state as a whole receives from hydro. The state average is about 10% from hydro. So we're quite a bit higher than that. And as you know, there have been a lot of dry years lately. Last year was a super wet year. So from year to year, the amount of hydro we can receive from our 2 resources can vary from 25%, like we had in the years of 2014 and 15, to over 80%, which we had last year during our super wet year. This graph shows our output from Western and the red bars and Calaveras and the green bars compared to the average year line, which is the purple line. So you see quite a bit of variation in that. And the reason that's important to us, of course, is that it has a big impact on us financially because although the amount of energy we get from our hydro resources varies quite a bit, the amount of money we pay generally is more or less fixed. It doesn't tend to vary too much from year to year with the precipitation levels or the snowpack. It's kind of a set amount that we pay and we receive whatever the resources generate. So that means in dry years like 2014 and 15, we have to make a lot more market purchases, and then our market purchase costs go up. And this graph kind of illustrates that. The blue bars show the hydro generation we've received over the past 6 years, and the orange line indicates our total market purchase costs. You can see there's kind of an inverse correlation there. 2017, we had a great year for hydro, and we're actually going to be, I believe we're a net seller of energy for the year. So we'll have a net revenue rather than a net market purchase cost.
Can I ask a question about that graph?
Sure.
So the orange line there, that's the total amount we spent. It's not the price per kilowatt hour.
Correct, yeah. Okay. Total expenditures for the year. Just on the market purchase category.
Yeah, I'm already donating to the utility rate stabilization.
There's a separate issue around hydro variability, which is that from month to month, through season to season, the amount of generation we receive from the resources varies quite a bit. We get a lot more energy in the spring and summer when the snowpack is melting and all the water is coming down into the reservoirs in kind of an uncontrolled fashion. And then in the winter months, we get a lot less. Sometimes we get months where there's zero hydro generation in a given month. And this graph shows all of our electric resources and our load from month to month. You can kind of see there's a mismatch where we have a lot more generation both from solar and hydro in the spring and summer, and a lot less in the winter months. So we have deficits in the winter and surpluses in the spring and summer. Although this presentation isn't really focused on this issue per se. All right, so to get now into the four main areas for managing our hydro variability. The first two here are physical hedging and financial reserves. Physical hedging is just making actual physical transactions, buying energy when we're short at a fixed price and selling it in advance when we have a surplus to lock in a price and minimize our market price exposure. And we're already doing that right now. We're also, of course, using financial reserves to cushion our financial exposure to hydro. The third mechanism is a rate adjustment mechanism, which I'll talk about quite a bit more in a few minutes. And the city of Roseville, up near Sacramento, they currently use the first three methods in a comprehensive way. And then the last method is weather insurance. And the Sacramento Municipal Utility District actually uses all four of these methodologies. And I've spoken to some staff at both Roseville and SMUD, so I've gotten a sense of how they arrive at those decisions and how they implement those programs. So again, physical hedging, typically what we're doing right now is simply making energy trades when we have surplus or deficit positions to lock in a fixed rate. A more advanced version of physical hedging would be a longer-term layoff of a resource where we actually get rid of a resource, get it off of our books, and then the output would go to somebody else. Or a seasonal exchange where we would sell energy, provide energy to a counterparty in the spring and summer when we have a surplus and get energy from them in the winter months, although it'll probably be difficult to find a counterparty who has a portfolio position that's opposite to ours who would want to get involved in a trade like that. And then for financial reserves, we have, of course, the hydroelectric stabilization reserve. Now to talk about the two new ones. Weather insurance. Weather insurance contracts are highly customizable contract structures, just like any other types of insurance. There are large insurance companies that are in this market. These products, they basically pay out to a utility when the total precipitation over a given period is at a weather station is below a certain level, and they have a contract premium or cost every year that's based on the payout amount and the precipitation level at which they start to pay out. You can also structure these so they're technically costless. They don't have an annual premium. But under those structures where you would receive energy or you receive a financial payout from the counterparty in dry years, but you'd have to pay them in wet years from out of your surplus. These types of products are not typically used in the utility industry very often. As I mentioned, SMUD uses them, but they're fairly rare in this industry. They're more commonly used by golf courses and ski resorts and concert venues where they have a really extreme level of exposure to weather events. There's some more detail on this in the report, but I did some analysis. I got some pricing from actual contracts, weather insurance sellers using an online tool called Weather Exchange. They put together this Palo Alto index of weather stations that's designed to represent our resources, which are sort of scattered around the northern and central part of the state. And this graph shows the historical precipitation levels at this index since 1950. That's the kind of the orange line or the red line. And then the lines indicate different contract structures that I got pricing for. Starting from the bottom, the red dotted line at the about the 10-inch level, that represents a contract where if the total precipitation is below that level, we would get a payout, and that's a relatively inexpensive product. It costs about $400,000 per year to get that level of protection. But as you can see, since 1950, there have been 0 years where that would have paid out to us, so probably not a good investment. The next highest line, the black line, at the 25-inch level, that costs a bit more, about $700,000 per year for that type of insurance. And there have been 2 years in the last 67 where that would have paid out to us. So also fairly expensive for the amount of protection it would provide. To get a little bit more of a robust level of protection, the contract at the 37-inch level, the blue dotted line, that would cost about $1 million per year, $1 million or to $1.1 million per year for protection below, for precipitation levels below that. So there have been a handful, about 8 or 10 years where that would have paid out, but we would be paying for that every year, about $1 million. And finally, the purple line represents the upper limit on a costless collar. So I got pricing for a costless collar product, and that's where we would be receiving payout from the insurance seller below the 25-inch level, the black line. And for any years where the precipitation is above the, I think it's about 63-inch level, the purple line, we would have to pay them. So as you can see, there are a lot more years where we would be paying for that product than we would be receiving a payout from them. So it's also a relatively expensive way to cap your exposure on the negative side. And this table just shows some of the details on those contract structures that I just described. But overall, our sense was this is a pretty expensive way to mitigate our hydro variability exposure, and we don't recommend it at this time. So to move on now to our recommended approach, that's the hydro rate adjustment mechanism. It's a fairly simple design. It's essentially a surcharge or a discount that will be applied every year to retail electric rates. It would be a separate line item on a customer's bill, like the drought surcharge. And it's simply designed to pass through our additional supply costs to customers in the dry year and to send back to them additional revenues that we receive in wet years. And the objective is essentially to maintain the hydroelectric stabilization reserve levels at a healthy level, which we've defined as being between $3 million and $35 million. And it's designed to avoid having to do large rate increases that would lead to big year-to-year rate swings. And the way it would work, we would activate this in the spring by council action during the regular rate adoption process. And at that point, around April or May, we'd have the rainy season would be more or less over, and we'd have a pretty good sense of what our hydro forecast would be for the upcoming year. And we would also have a good sense of what the hydro stabilization reserve levels would be by the end of the fiscal year. We're proposing to implement 3 levels of rate discounts for wet year conditions, ranging from 5 to 14% of our system average rate, and 2 levels of rate adders for dry years, ranging from 5 to 10% of the system average rate. And that converts to a bill impact for the median residential customer of between $3 and $9 for the 5 to 14% range per month. And then the hydro rate adjuster would remain in place for the following fiscal year. So it would be activated in the spring. It would go into effect July 1st and remain active until June 30th of the following year. This chart here kind of shows the exact methodology that we're proposing. On the x-axis, we're showing hydro generation from our 2 combined resources, Calaveras and Western. The middle vertical line at 548, that represents an average amount of output from the hydro resources on an average year. And the 2 lines on either side of that represent 1 standard deviation above or below average levels. On the y-axis, we're showing hydro stabilization reserve levels, going from the minimum at $3 million all the way up to the maximum $35 million level. So depending on where we fall in that, where the hydro forecast falls and where the reserve levels are, in a wetter than average year with robust reserves, we would be implementing a rate discount in these shown here in these blue boxes. And conversely, in a drier than average year where reserve levels are already pretty low, we would be applying a rate adder in those years. We did some more analysis. We did some Monte Carlo simulations of our hydro resources over time. This slide shows one 20-year simulation of a series of dry years strung together. And the top two set of graphs show what would happen with the hydro rate adjuster in place. And the bottom graph shows without the hydro rate adjuster in place, a series of dry years would push the reserve levels down into negative territory. So we would have to implement a large kind of permanent rate increase around year 6 to maintain reserve levels above zero. Whereas with the rate adjuster in place in the top graph, through a series of small kind of one-time rate adders, we would maintain the reserve levels between the dotted lines where we want to keep it. And on the other hand, in wetter conditions, this slide shows another simulation of a 20-year period where we have a series of wet years strung together. So you can see in the bottom graph, without a rate adjuster in place, reserve levels would reach pretty excessive levels, and we would at that point want to adopt a large rate decrease. But with the rate adjuster in place, in the top graph, we're able to maintain reserve levels, in that desired range through a series of smaller one-time rate decreases or rate discounts. So this is just a summary of the 4 different options. We're currently implementing the first 2. Weather insurance would be a good way to cap our financial exposure for sure, but it's an expensive method. And rate adjustment mechanisms we feel are simple and transparent. They are very low cost, and they would do a good job of ensuring the stability of our financial reserves. In terms of implementation, on a year-to-year basis, we would make the final determination of whether to apply the rate adjuster in April or May and take that decision to the City Council through the rate process. And it would go into effect in July of that year. And that's all I have.
Why don't we take do we have any public comment? No. Let's take a 5-minute break and get some food. Here. Or wait, we'll eat.
You want to bring it in here, or?
Yeah, bring it here.
to the weather pattern?
Sure. Do you want to talk to the?
He's been around long enough.
Yeah, Monica's been here longer. I'll defer to her.
Well, I can't speak to those decisions, but, so we have two resources, and, I'm sorry, Monica Padilla, Senior Resource Planner. We have two resources. One is Calaveras, and that one supplies about 14% of our energy needs. And we are actually part owners of that project through the Northern California Power Agency. So we agreed to construct that facility, and we're basically an owner. So the only way we can get out of that one is by finding someone to take our share. And that would be difficult since this project is an expensive project with variable output. The Western contract, we are actually a participant or a customer of the Central Valley Project, and we receive about 11% of the output of that project under a contract that started back in 2005 and expires at the end of 2024. So we can't necessarily get out of that contract right now, but we're evaluating whether we want to extend that contract for another 30 years come 2025. And that'll be the basis of our integrated resource plan that we bring to the UAC Finance and Council this fall. So that's the big question. It's a carbon-free resource. And on an average year, and the expected case, it is a valuable resource for Palo Alto. It always has been. It's just the dry years that kind of throw us for a loop. And that's why we use reserves to manage the cost uncertainties. But it has overall been a good resource for us.
So, you know, like, I didn't know we owned anything at Calaveras, but since we own, would it be more financially feasible to purchase more shares and not do the Western, or?
Well, that would be difficult too, because we'd have to get another one of the owners to be willing to lay off theirs to us. And because there's so much debt associated with the Calaveras project, it's a pretty expensive project. The debt on that resource gets paid off in 2033. And the relicensing of that project starts about 2022. It's a 9-year process and upwards of $50 million to relicense the project. And we're going to be looking at whether that makes sense or not, and whether Palo Alto wants to participate at its same share. We have 23% of that project.
23?
23% of that project. So those are questions that we'll ask, but we'll ask them in the context of what the alternative carbon-free resource and what the value of those other resources are. So at the end of the day, we have to buy carbon-neutral, carbon-free resources to meet our load obligations. And so it's just a question of what the best resource to meet our needs are.
Thank you. I learned a lot. Thanks.
Microphone, please, sir.
Yeah.
Thank you.
So all these mechanisms essentially are to insure ratepayers against volatility, right? And the net effect of all these things is that it sort of moves around payment from one year to another. That is, if you look at over a long period of time, we're paying the same amount of money, right? It's just that rather than pay a little this year and a lot next year, we're going to pay a moderate amount in both years.
Yeah,
So
that's right.
I really liked your chart with sort of varieties of weather insurance here, because, I mean, I assume that any of these mechanisms, we're going to pay something for the insurance, right? Okay. Right now we do it with, we maintain reserves, but we have 20 million in reserve, and the city's cost of capital is 4% or something like that, so it's probably costing us $1 million a year or something like that for that. So when we look at these mechanisms, I mean, beyond just I assume, actually it's kind of interesting, I assume that the lowest cost alternative is we don't insure, okay? We just pass along the cost to ratepayers, and we adjust every 6 months like it says in the, right, or 3 months or something like that. But is that an accurate statement? Because I was kind of interested in your point about there's sort of a double whammy in dry years because we both have to buy more, and also the cost is higher because there's more demand. So is it still accurate that the lowest cost alternative is to not insure at all?
You want to ponder that? So I'll give you an opinion on that and see if it's validated by people who know better. I actually think that what we're proposing is the lowest cost option because it ensures a more timely adjustment to the rates relative to when, let's say, a dry year or a wet year. So if there is any impact on demand by an increase in rates, then that will happen in a more timely fashion than if we went through a whole new rate setting process, both in an analytical process as well as, let's say, to do a rate increase. The notifications, all of the analytical processes that would typically come with any change in rates that was not kind of preloaded to the extent that we're doing through this adjuster.
And also keep in mind that if you didn't carry any reserves, I think that would have a negative impact on your credit as well. So that would be more costly perhaps to borrow.
And I
Well-
think your 4% is way overstated, because the true cost of capital is not to the city, it's to the ratepayer. And so it's the ratepayer could get in a savings account, because it's not a lot of money. So, from each individual ratepayer, it's what they would get, not what the city would get, because the city's basically collecting money from ratepayers. So I would put it at about 0.5%, given what I get on my savings rates.
To ponder that, okay. So I guess what I'd like to understand overall is if we go down this path, and I think what I understood you just say is that actually the administrative costs of rate changes add up to the point where actually simply passing through the cost to consumers, ratepayers, may not actually be the lowest cost alternative, right? I guess what I'd like to understand is, in general on these things, is what's the lowest possible cost, and then what's the premium we're paying for the insurance of various different mechanisms, right? And the HRA sort of being one. So how much, I guess I should know this off the top of my head, right? But what's our revenues per year for electricity in town? It's like $100 million or $150 million or something like that.
150 or so, 160.
Okay, so if we're talking at several $100,000 as on your chart, then you were looking at 0.5% or something like that. So 0.5% or roughly of the cost of the rates is insurance for volatility. If you use some of your mechanisms here.
Are you assuming a particular reserve level?
No, actually, I was just trying to ballpark the cost of insurance in general. You actually have a chart with some mechanisms with puts and so forth. Yeah, that one. So you're looking at sort of the $400,000 to $1 million range, and so over 150 million in revenues, you're looking at 0.5% or something like that, right? Right, is the incremental cost to ratepayers for the insurance, at least of these options. I think my instinct is what you proposed seems reasonable. I'd just be really curious what the costs of all these things are to ratepayers, right? Because I think, in general, we should try to minimize long-term costs of ratepayers, and there is some value with moving it around from year to year, but we shouldn't pay too much for trying to protect people from volatility, because it is what it is, right? We're not going to be able to protect them in general. Years when we're at 80%, right? We must have more power than we know what to do with. What do we do with the extra?
Sell it.
And can we do that? And no.
You want me to answer, or do you want to answer?
Yeah, we regularly have surpluses that just get sold into the ISO market.
Okay.
Yeah.
At reasonable terms, or?
Sometimes we have to pay to sell.
Not that often.
Yeah, generally, prices are a little bit lower in wet years when everybody has a lot of hydro, supply and demand. But
And I assume that, our investment to administer this is negligible. We don't have to hire 20 FTEs to, okay.
right. Yep.
Is there, when rates are high in Palo Alto, is there actually any data? you know, your assumption is, well, if rates are high, then people will use less electricity and so forth. But is there any evidence? I mean, do we know that? Is there any data in Palo Alto to show that's true, or is it sort of hard to
I think our rates have been too stable to actually really gauge that.
Okay.
We did see some change when we did the increase last year. I don't recall what the magnitude of that change was, but I think it was pretty small.
Very small, okay.
I think in general, our load has been decreasing
Okay.
steadily for the last few years, and we've had pretty stable rates. And we actually did do that very same analysis that you requested back in 2007, 2005, to look at the different alternatives, whether we should hold reserves or just pass through as quickly as possible.
Right, and what the net
And what the cost
to
was of
ratepayers
holding
was?
net reserves and what the impacts would be on our credit rating. I don't remember the results, but the bottom line was that when we took that discussion through the UAC Financing Council at that time, for them, key was rate stability.
Right.
And they didn't want to see us having these huge swings, and they liked the idea of self-insuring by holding reserves and didn't feel the cost of that was significant. So that's what we've been operating under for the last 10 years since this contract kind of has taken shape. But it's certainly something that we could look at again if that was.
Okay.
But-
I'm just curious. I just like to know what the cost is, right,
So
of doing it.
I agree with Eric, and we can come back. I just want to jump in on that. When I first joined the council, I think that's where the utilities was on rate stability. And we slowly moved away from that to cost being the driving factor, at least I think we have. We looked at gas and we went away from a laddering strategy, which I thought cost a lot. And, you know, it was a bit of a fight. I remember that. We had to, and we finally got rid of the laddering strategy. And now, basically for cost reasons. And so I think what you're asking for is exactly the way I think about it too.
Well, if
What does
it's-
it cost us?
I mean, if it's $20,000 a year, then it's one thing. If it's $1 million a year, it's something else. But if it's, take a mean on your chart, if it's $500,000 a year, then, you know, that could finance $5 million worth of capital investment, which is a history museum or something like that, right? I mean, it's not exactly fungible, obviously, because it's utilities, but we should know what those costs are, right? Right, as opposed to not knowing.
Any other questions? Greg?
So thank you for your work on this. I found it actually quite interesting. Okay, so in terms of our investment in, was it Calaveras? What was the name of the?
Calaveras.
Calaveras, okay. How does that investment work? So we paid how much in, and what do we get out of it?
Well, we're part owners, so when the project got funded, there was revenues bonds that were issued by the Northern California Power Agency, and we're obligated to 23% of those revenue bonds. On an annual basis.
So we owe 23% of the bonds?
Of the bonds. On an annual basis, that works out to be about $8 million a year.
Okay.
We get 23% of the output of the project, and the output is dependent on the hydro conditions. So generally, that's about 14% on an average year of our electricity needs.
Okay, so we pay about $8 million a year.
Yeah.
And we get 23% of the output, whether it's
Right.
zero or whatever.
Right. If you exclude the debt, this is a really super economical resource because it has very little O&M associated with it and no costs essentially related to the fuel.
Okay.
But with the debt layered in it, it's an expensive resource.
Okay, so, and so if we look at the graph in terms of a typical output, I saw that graph somewhere. It's, or I thought I saw the graph. Is this graph what the output is?
That's the graph in an average year of our total hydro supply, the blue area.
So this is the 23% that we're looking at.
That's Western and Calaveras combined.
Oh, okay. But Western, so how does it work with Western?
Sorry?
How does it work with Western?
So Western is a resource owned by the federal government, and we receive a fixed percentage of the total output of that resource as well. But
How much is that?
the total cost of that,
No, the total output.
we get 12% of the resource, which provides about 40% of our total supply in an average year.
But then what is our payment then, our obligation?
The cost is a little more variable with Western. There's what's it called, PRR,
There's a power revenue.
power revenue requirement, and then there's the Central Valley Project Improvement Act Restoration Fund for environmental restoration. And those kind of vary from year to year. There's kind of a cycle to them, but it's around, total cost of Western is around $12 to $13 million per year.
Okay, but it's not fixed. It varies depending on the drought and whatever.
Yeah, a little bit, yeah. Restoration costs.
But we
are-
get 12% no matter what. Are we obligated to take 12%, or are we? Is it we take what we want?
No, we're obligated, the only reason we can't take our Western-based resource allocation is if we don't have the load to take it. But in general, we have sufficient load to take our full resource, so we are obligated to take 12.3% of whatever the output is, but as Jim mentioned, it could be zero in certain months. And then we have an obligation to pay 12.3% of whatever the costs are, and those are not ever zero. For the most part, they're fixed. They vary slightly, but they're pretty much fixed.
Okay. Interesting. So 60% is from Calaveras, 40% is from Western, and we have essentially fixed. Well, we have a fixed percentage, but variable output depending on the weather. But the costs are very real, right? It's like 8 and 12, 13 million. Okay. So one thing I didn't see in this report is any modeling in terms of, I saw the Monte Carlo model, right? But I didn't see any modeling because you made the remark that the options were very expensive, but I didn't see any modeling of the strike prices and how that varies with, we have fixed obligations. So to me, this screams like this should be like, we should hedge this with options. I haven't done modeling yet either, but I didn't see it in here either. So I was wondering, did you guys do it and just not show it to us? Or how do you know that this is expensive or not expensive? Like, what's the basis of that remark?
Yeah. The basis of that was simply comparing the cost to how they would have done historically, based showing like on this graph here, just the amount of payout they would have generated over time, and the total cost per year.
But the issue is that what you're not looking at is what would have cost us if we didn't have this, right? So we, if you, because essentially you have put options, and I guess they also have call options too, right? And you can also buy or sell either instrument, right? The thing I didn't see here is like, so I used to trade options. So I was looking for graphs like this where you could actually see the strike price. You could see how the curve changes, right, depending on where the amount of rainfall is. And we have some fixed obligations here, but I didn't see any graphs at all or any analysis like this that factors it in, because just to look at this by itself and say it's expensive or cheap is not factoring in the fact that we have two large fixed obligations that we have to pay no matter what happens, right? And this is highly variable on the weather, right? And together, like, this is what, $20 million or so, right? Together. And I'm looking at the annual premium for this. It's like 5%, right? I mean, so the strategy right now with HRA is let's just pass on the ratepayers. We have a big buffer, and we'll pass, if the fluctuations are big enough, we'll just pass on the ratepayers. No big deal. I mean, that will work. Don't get me wrong, but I mean, there's financial instruments here that can hedge the fluctuations, and it sounds like you didn't do any analysis at all in terms of modeling how this fixed obligation effects could be hedged with the options. Because what you want is like kind of like a portfolio theory, right, where things cancel out. And it's actually it actually could, because right now with the current strategy, it's basically we're just put on the shoulders of our ratepayers, right, versus actually making an attempt to hedge.
Well, I think the goal is to minimize volatility, right? To smooth out the highs and lows. Correct me if I'm wrong. I'm not an options trader. Don't know enough to be dangerous about it. So it sounds like the alternative strategy would be to actually use the options would be to generate a profit.
Options on what?
No, so they have what their derivatives, right? That you get a certain payout depending on the weather, right? And so we have two things going on here. We have we have a relatively fixed payment, variable output, right, that fluctuates depending on the rainfall. And so, so some years, like if you look at the other graph, some years we do gangbusters, right? Probably too much water. Right? We have to too much power, right? And so we have to sell it off, which we actually maybe get some excess cash, or maybe everyone has too much power. Maybe the rates are lower. I'm not sure how it works, but we have something that's incredibly variable. That, and I haven't done the math yet. And I thought maybe you guys had done it, and that's why you thought that these were expensive, but. You can't, I think, I would argue you can't just tell by looking at this, because you're not connecting it to what we're actually paying and how that fluctuates as well. Right, I mean, you're just looking at this, and because you can't, it's hard to make a judgment call, this is expensive or cheap until you see how it hedges against what we have to pass on to the ratepayers. We could say, well, the ratepayers are not the city, so it doesn't matter what we charge them. But if we were looking out for the best interests of our residents, then we should consider residents ourselves as well. It's not like we could just pass the buck. It's still cost. It costs our ratepayers.
Can I was going to say, I think, I mean, I don't know what it is, but you need some kind of a baseline somewhere. And sort of my assumption coming into this was the baseline is you do no insurance at all, right? Every day you adjust rates, right? And you pass it straight on to the ratepayer, so you're paying zero for insurance. And I think to the utilities director's point is that it might actually not technically be the lowest cost solution because there's an administrative cost associated with changing rates. But at some level, you need a baseline. What's the bare minimum we could pay? And then all these other mechanisms, you're going to sort of compare the cost of that insurance mechanism, whether it's holding a big float, right, or whether it's building a hedge out of a variety of kinds of instruments, right, or whether it's weather insurance or something like that. So I think that's the way we should look at it. And I don't quite understand exactly what Councilmember Tanaka's hedge, right, structure is, but that potentially seems like something we could look at too, right, depending on how much it costs, because it's not going to be free. Obviously, options aren't free, right?
So I guess it comes back to what are we trying to achieve? So I guess
cheapest rate stabilization.
Right, cheapest rates that are stabilized. But personally, I actually want cheapest rates. I'm willing to have more volatility. I don't want us to pay a lot for volatility. No, I mean, you're right.
Me too.
Right, I think.
I don't want to pay much for insurance.
So, assuming that I want that, I assumed what you're doing here does that because I don't see you going out and paying for anything. You're not buying insurance. All you're doing is you're adjusting rates quicker than if you adjusted rates, what we've currently been doing, which is you wait 5 years, you pay down the
Bring down the reserves.
You pay down the reserves, and then if you're
build it
still,
back up.
then you adjust rates more. And actually, and get me if I'm wrong, but I actually like this model because it doesn't lead to a large rate increase suddenly. Because that's what we typically do. It's only you have a 6% rate increase. Everyone's like, oh, right? This way it's just, and the rates go down too if we overproduce. So I liked all that. So I'm not interested in the insurance because I think it costs extra money, and why would we pay that extra money for what seems to me to be very little benefit when I look at that chart? So this didn't seem that hard to me. Then Councilman Tanaka raised another question, which I actually wanted to explore just briefly. I wanted to ask Greg a couple questions. So if we do what you said, were you thinking what we'd end up with?
Well, I'm not saying doing what I said. The problem is I don't see the analysis, right?
Okay, but assuming the way, let me understand, if they did the analysis, would that show it cheaper for the ratepayers in that?
It could be considerably cheaper for the ratepayers.
Than doing, how? That's the part I don't think anyone in the room understands, is
So,
how could it be cheaper? You have to dumb it down for us, Greg.
Okay, so the way to think about it is, okay, for instance, do you have fire insurance?
Yes.
Okay, so what if you had a fire, right, and you didn't have fire insurance? What happens?
Okay, but think about it this way.
Right.
If the city self-insures, which is basically what it does, right? So, I mean, it actually would be considerably cheaper for me if I self-insured, if I had that kind of,
But you tie up capital, and there's cost of capital, right? You're tying up $17 million, And really what's happening is not really
But it's
hedging.
not our cost of capital. That's my
Well,
point to
it is,
No, so.
Why?
because the city's got to hang on to it.
Sorry, but we get to keep it. It actually, if anything, we make interest on it.
Yeah,
Okay, but
I
we
mean,
gotta-
this
but-
is actually.
But we gotta set it aside in a fund somewhere instead of spending it on new police buildings or something
but-
like
No,
that.
but it's not
But-
fungible.
But Greg, this is not a philosophical debate. This is actually a math, right? This is like someone should do the math and figure out what it is. Because this is not a philosophical discussion. It's like we should model it out, do the math, and see what it is. And if it's better to do the
So
HRA,
explain to me
I'm totally for I'm
what
totally
the
for that.
math, explain to me what the math could show. That's the part I don't get.
Well, I'm still trying to understand this a bit, so I have a few questions to understand this. So
Let me see if I can answer Councilmember, Chair Sharp's question. I think the cost of the HRA mechanism here is the same as the cost of what we're doing now, which is whatever the capital cost is of carrying the self-insurance fund, right? The HRA thing seems like a slightly better way to do what we're doing right now already. And so, to the extent that there's money to be saved here, I think Councilmember Tanaka is assuming that if we did we did it a different way, then we wouldn't have to hold the reserve, and the cost savings would be the capital costs of holding the reserve. And then we're having the discussion about what are the capital costs of holding the reserve? Are they, the city's costs or the ratepayers' costs?
No, wait, is that correct? Because what,
the thing is I
Is that
think-
correct?
The thing is, because I don't see an analysis, I don't know, right? And the HRA may be the best
but
way.
forget the analysis, just think
Okay.
theoretically.
It's not theoretical. It's all about the math, right?
It's not, it can't
It
be
is
all about
math.
the math.
It's the math, right?
Look, the
Because
math may give you the answer, but the theoretical framework has to
okay,
define the math.
theoretical framework is you could hedge the downside with derivatives, right?
Correct.
Okay, so so to judge whether it's expensive or cheap based on that doesn't make sense. So the graph that people look at is a graph like something like this, and I don't know if I got the numbers right, which is why I have a few questions. It looks like a graph like this. So the strike price, let's say, is at 37, right? And then I assume this 400 is $400,000 per inch. So every inch is below 37, you get 400,000. Is that the way it works?
That's correct.
Okay. So what happens is, once you hit 37, you start, but you have this $9 million in a hole, right? So you start $9 million in a hole. So this is dollars, right? Dollars in a hole, dollars ahead, right? So what happens is you're at 37 million. You go to 36, you get basically $400,000, right? So this is a slope of $400,000. Then I assume that you have this 5-year limit is a $15 million cap, right? So we can never. So it's actually most options go straight up, right? So the upside is unlimited. In this case, it's capped out by 15 million. So you have to consider what the cap is. So this is what this one instrument looks like. Now what you got to do is you got to look at, well, what does our obligations look like in terms of the Calaveras and Western? Okay, how does that look? So because that's also a line on this graph. And then you put the lines together, then you see what you get. So let me understand this other line, because you've got to know what this other line looks like. Then you can add the two together and see how they cancel out, right? We can see where that puts you on this, right? So we have a fixed $8 million a year cost. 60% of it comes from Calaveras, 23%. So the thing is, I'm trying to understand is how does the you get 23% of the output. How much is power? That's the thing I don't know. So I'm trying to understand. I don't understand the. Do you guys have a graph that relates the number of inches to our cost from Calaveras? Like how much it costs for the power?
It's difficult to convert number of inches of precip to generation because it depends on the watershed and how, historically how full it is.
Yeah.
And what, over a long period of time, what precipitation conditions have been like in the hydrology of the area.
Because I would assume, okay, so what I would assume is, I don't know what this line looks like, but I would assume it's like something like this, okay? Because what happens, the way I'm just thinking about it from a theoretical point of view, is that more water pours in, we get 23% of that. More water pours in, more power we generate. And I'm assuming that the cost of kilowatts don't plummet like as you generate more. I'm assuming that, right? I'm assuming that hydro is a relatively small amount of the total power market. So it's not going to swamp the market out. Maybe it tapers off a bit, but it's basically a straight line up. So it's a linear line like this. So you put the two together, right? I don't know, the problem is I don't know where the slope of this line is. I don't know the y-intercept of this line. So I don't know really where this line is. But the reason why I think this instrument could work, and I think someone has to do the math on this, and I can't really do it because I don't have enough information, is that if you add these two together, it cancels out. Right? You don't know what I'm looking at, but if it cancels out in terms of, because what happens is, just to make it simple for you, because you can see what I'm drawing is, I think these are the right fundamental shapes. Again, I don't know where the lines are because this is like a big unknown right now. It's not nowhere in the report. But if you add these two lines together, what happens is, assuming the slopes of these two are the same, this becomes a flat line. Okay, it becomes a flat line. And then on this part here, it starts to go up. And then on this part here, it starts to go down, right? Because it's flat up here. There's a cap. So what it does is it converts something that's like a straight line, where if you're like seriously drought conditions and you're seriously in the hole, to something where this basically, and I don't know if this is above or if it's positive or negative for us because we don't have this information. We don't have this line.
So
But
essentially what you constructed there is a hedge, right?
It's a hedge, but the problem is.
So are you arguing that the hedge is mispriced?
No, I'm arguing that we didn't do the analysis, right? We don't have, in order to make this analysis complete.
But what are you going to find? You're going to find out that the cost of the annual premium, is wrong, and we can make money on the hedge. Is that what you're?
No, so the fundamental. Okay, so we have information for one curve, right? Which is this kind of like, I don't know what you call it, but it's like this kind of curve, right? We have this information. That's what this information tells us here. What we don't know is we don't know this line. If we know this line, then we can actually add them together and figure out how this works.
And then we'll find out that either the price of the hedge up there is either too high or too low, or just
Exactly.
about right.
Exactly. So it's a math problem. It's not a sit here and debate problem.
So, but that's the market clearing price, okay, of what this hedge would
Yeah.
cost.
So
you're arguing that the reason to do this is that actually may be mispriced and there's an arbitrage opportunity.
Well,
Is that
I think
That's what I was trying to get at.
Well, I think
that's right.
it's different for every city, right? Because what's unique for us is that we have this Calaveras ownership and we have this Western contract, right? That gives us for a relatively fixed amount of cost, it gives us this crazy amount of output, right? That's kind of variable. Inherently, the reason why you buy options is to moderate that, right? And so the fundamental graph we're looking at on the y-axis is how much in the hole or how much above are you? That's what you care about. And if you're above, life is good. You should do it. If you're going to be like negative, you shouldn't do it, right? That doesn't make sense. If you're likely in an area of likely to be negative, you shouldn't do it. You should just do HRA or something else, right? But the problem that we have here is the analysis is only half complete. We don't know this curve. We don't know our supply curve, essentially.
I guess what I don't understand is if we're paying $1 million a year for this option
Yeah.
and it's only paid out, 6 times over the past 60 years,
Yeah, but
and it's capped at,
okay,
a few million dollars. How is that?
Let's take that example. So let's say we are at this black line, right? It's only paid out twice. What would happen? How much would Palo Alto be on the hook if we 2013? How much? Well, actually, you actually know, right? Because we didn't have this hedge. So in 2013, how much more power do you have to procure? You know what it is, right? Because we have our 2013 numbers. You can look that up,
Right, so,
right?
so we were short about 250,000 megawatt hours.
Okay, how much does
So
that
that would
cost?
cost about, say, 8 million, 9 million.
Okay, so what we have here is we have inches on one side. The other side is cost, right? So in 2013, what was the inches in 2013? Okay, 2013, what was the inch? It was
15.
15, okay, so at 15, how much did that cost us?
400,000 an inch, was that?
No. How much power do we have to procure?
About
250,000?
9 million or so.
9 million, okay. Okay, and then so we only need 2 points for a straight line, assuming this is a straight line, which is a big assumption. So let's take another year. Let's take 30 inch, 2007, what happened in 2007? So at 30 inch, what was it?
Looks like we were short about 150,000 megawatt hours, so call that $6 million.
6 million, okay. So let's assume this is a straight line. So I wish I had a graph paper here. But basically, you just need to graph this line. You need to graph this line onto this chart, and then you know if it's expensive or not. And you could do it for different financial instruments, right? And then you can answer the chair's question, right? Is this a good deal for us or not?
Let me see if I can take a question on this. There's a discussion of some of this at SMUD, right? And he said that, because essentially what you're talking about is an extreme tail, right?
No, it's just, this is
Very
just trying to plot our.
No, you're looking at the extreme drought year, okay? That's the one you picked, okay? So SMUD's experience, these extreme tail insurance contracts have never paid out to them, right? And so that was your assessment of this, was you said you looked at SMUD and said, never did anything for SMUD, so
But that's
you
not,
didn't
that's
pursue it any further?
but you can't think of it like this, right? You have to think about it in terms of what, this tells you the possible scenarios, right? How much water how much rainfall do we get, and how much do we pay out? Actually, I just thought about it. It's actually, well, maybe there was a cap, I don't know, but it's math here. This is not a,
But you're really looking for an arbitrage opportunity.
I'm looking for just the analysis to be complete, and it's not complete right now. It's missing this graph here. And then we could tell. Then we could tell that whether this is a good deal or a bad deal.
I don't believe staff knows how to do that graph.
Well, and also,
Well, we almost
And
have it. If you have graph paper, I could do it
The
in 10
fundamental
minutes here.
argument I understand here about all these kinds of things is that if you look out over a long period of time, there's a chance you'll have some, I shudder to use the word black swan, but okay, some outlier events, okay? And your hedge will protect you from a large expense in that year. So you said $8 million, for example, in 1 year. So in that case, the hedge would absolutely have protected you against that, right? Balanced against that is the annual cost of the hedge, because you're going to have to pay $500,000 a year or something like that for the hedge for all the other years, right? And then the question is, how does that net out with the probability of the outlier events versus the typical years? And that's the arbitrage opportunity you're talking about.
And
so
unlike-
I think for your analysis, you really have to understand, a long period of time in many events, not just the black swan, which is, I think, what you're trying to do.
No, I'm not. What I'm trying to do is, okay, so this graph that I'm drawing here is a typical option trading graph. Okay, it's basically your payoff here. This is your payoff on the Y, and the x-axis is what could happen. We're talking about inches of rainfall, right? There's going to be some sort of bell curve or so that's going to be in terms of what's most likely to least likely.
Right.
And what you want to do is you want to be in a couple of standard deviations of that, and you want that to be positive, because that's what's likely to happen. There's a black swan event that might happen that might wipe you out, but it's very unlikely. What you want to do is you want to get above this line for the likely,
Okay.
right? That's
So then you're arguing there's an arbitrage opportunity, okay? But the amounts of money we're talking about here are $500,000 a year, $750,000 a
Yeah.
year, and so forth. And so I'm going to guess that to the city, such an arbitrage opportunity, if it's between $500,000 a year and $400,000 a year, probably is not. It probably doesn't rise to a very high priority unless you can figure
Well,
out
that-
that
you got to
actually
reverse though.
that actually it's a $2 million a year opportunity. Right?
No, but you got a reversal. So you're right. $500,000 is not a lot of money to us, right? So but if you don't
It is in
hedge,
the absolute, but yes.
if you don't hedge,
Right.
you could be looking at like we've got some numbers here, $9 million or $6 million like obligation.
Yeah, but-
So paying $500,000 to hedge, to not have a $9 million like payout or a cost is significant, right? Look, in I forgot your, what that was.
Half a million dollars a year for 20 years.
Yeah, I mean, you're right about that, right? But this is why I'm saying you have to kind of graph this out and see. You have to see, like, you have to see what this line is. Because if you don't do that, it's hard to know, is this a good deal for us or not?
The question is, what's the magnitude of the goodness of the deal? Right?
We
Is it
looked
worth
at
the-
it, 9
is it
million to
worth-
6 million.
No, that's
right?
not right, okay, because you gotta look at the $500,000 a year over 20 years.
Okay,
right?
so let's say $500,000 over 20 years, that's $10 million. So in 2 recent years, in 2000 something, we paid 6 million and 9 million. That's $15 million, right? If you did it over 20 years, you hedged $10 million. So this is already $5 million ahead.
So do they only pay out the tail part? They don't pay the whole 9 million? They only pay the little tail part, right? They don't pay the whole 9 million.
No, they don't.
Right. So it's not even 9 million.
No, but you're saying that, I asked you how much more power did we have to, how much more do we have to spend for this power?
Right, and we still have to pay, we would still have to pay that even with the insurance policy in place. We would still
Right.
have to buy the $9
We will
million
pay it, but we
of
get a
power.
payout from the insurance policy.
Yeah, but only for the portion below
Below the
I know,
line.
I know,
line.
I know.
But
I know
that's
that.
not 9 million.
I know,
Well, I'm
no,
saying
I-
it's not 9
No,
million.
I know, but that's why I need to model this.
Right.
Right, it's not properly modeled. So
But I
would-
just wanted to make sure what you were talking about is not the volatility. You actually believe there's an arbitrage opportunity. You might be right. You think you're right. That is a math issue. Is it an arbitrage issue that we could actually, do better in making money?
Yeah, I mean, I think, and I saw the comment about the other utilities, maybe it wasn't good for them. But the thing about options is they're highly personalized. It depends on your situation, right? It depends on what's going on. I mean, they may not have this ownership in this 23% stake or the 12% thing. I mean, so that's why what we need to do is,
Let me ask a question. Would staff have any idea how to run those numbers for Greg, or not?
I mean, I think we could,
couldn't run
we could probably simulate something and look
there's
at,
nothing to simulate. It's like basically graphing 2 lines on a graph, and then you can figure out what's going on.
what
I
do
can
you-
almost do it now if I had graph paper. So,
I think where we're gonna go with this is, we're probably gonna go with what staff wants to do, because it makes total sense. What you're raising is, which is almost separate and apart from whether or not we do this, whether or not we should also hedge these.
I would say that we don't know right now.
No, you don't, because you gotta not do, in order to pay for what Greg wants to do, you gotta not do what staff's proposing to do.
Why? Explain that.
Because the cost of what staff's proposing to do is
There is no
the
cost.
flow.
It's taking $17 million.
You're sitting around at $17 million.
Okay, so let's talk about that, because I don't believe there's a cost to that money. I mean, I think it's very, very small. I mean, very, very small. It's whatever the ratepayer's number is. And mine is, if I put my money in the savings account, it's so small, I don't even notice it these days. So, what do we get on a savings account these days?
It's like 0.5%.
So that's what I say, 0.5%. So 0.5% on 17 million.
But you missed the point.
We already have the reserves there, the hydro reserves, and in theory, with the rate adjuster in place, you could actually reduce the level of the reserves.
And that's what I
because,
heard.
Exactly.
But Greg is saying we would have no reserves roughly, right? I mean, that's
Well,
what I'm
we can still
assuming.
have reserve, but my point is that that's not the way to think about it in terms of how much interest you get on 17 million. The way you have to think about it is, well, what if we have a really dry year? Then suddenly we're paying $9 million in extra power. That's what you have to think about.
I'm gonna read the staff report here, okay? The carrying cost of holding large financial reserves can, depending on interest rates, be quite significant itself.
I know, it's that. Whoever wrote that, you might want to rethink it.
In this context, for sure.
What were you thinking, exactly?
So I would say they should just do the math and come back
I would
to us.
agree with you on the general fund, actually.
Right.
I do think it's different on utilities. I think it's totally different.
Well, I would also add, I think going forward as a strategy, that Councilmember Tanaka, I believe what you're suggesting would require not only a one-off ability to analyze it, but on an ongoing basis, the ability to continue to analyze it as additional information comes to the table. And especially as, whether it be the rates we're paying or the cost of the options along the way.
And I know you think it's all math, but, I forget which city it was, but there are cities that have delved into derivatives and this kind of.
That's
Orange County.
That's if you sell them. If you buy them, the downside is capped to $500,000 wherever you paid for it.
Well,
If you sell it, that's a different story.
all right.
So I'm not advocating that we sell naked puts or naked calls. I'm just saying we use it to hedge, that means your downside is no more than what you paid for it.
I'm just saying, some point someone's gonna screw up on this stuff. And this is
That
not
is a
staff's
concern.
expertise by any means.
Exactly.
And council does have under the Energy Risk Management Program that council approves, they did approve a policy which basically prevents us from looking up arbitrage opportunities and instead focus on our business of procuring electricity supplies and setting the rates to pay for those supplies.
And we did change that once for the interest rate swap issue you wanted. There was some things you actually looked at where you brought us and said.
Congestion revenue rights that we use to hedge the congestion between our load and our resources, yeah. Those are our financial derivatives. But aside from that, we are prohibited from transacting in derivatives. And if we do transact in derivatives, it opens up a whole bunch of regulatory requirements related to Dodd-Frank. So in general, we tend to stay away from that stuff at council's direction.
Well, that might be misguided, because I think,
But it's current council policy.
well, maybe, but I think maybe it's because the current council didn't understand what's going on,
And that may be totally true,
so.
but then the appropriate thing to do is to actually research it, talk to people and write a colleague's memo and get it changed.
Maybe. I'm just saying that,
Oh, I-
we're making a decision with only half the information.
All right. So what you're looking for is a motion, right, to move forward on this?
Yes.
Yes.
I would like to satisfy Council Tanaka, but I haven't figured out how to do that.
Well, how about this? I sent questions in, but staff declined to answer, which would have helped me on this, but, well, maybe. But, so we're doing it here instead of ahead of time. I could help you guys with this graph. And, but I need information. I can't just make it up. And if we had it, you may absolutely be right. The HRA may be the right thing to do. But I think at this point, I don't think we know.
All right. I will move the staff recommendation. Any further comments?
I think it's just,
Misguided.
it may not be misguided. It's just, we're ill-informed at this point.
Okay. All right, anyone else? Any comments?
Seems like an improvement on what we're doing now, an incremental improvement on what we're doing now.
That's what I was going to say.
Radical restructuring, which may have its place too.
So that's really what I was trying to tell Councilman Tanaka, is this seems to be an improvement over what we're doing. What you're suggesting may be a good thing to do, but I think it's not within the scope of this meeting, really. I don't think staff really knows how to do those graphs. I don't think they know how to put the information together for you. I don't think we have council members do staff work. That does not go well. But I also think it violates council policy the way it's currently written, which, as you said, may not be appropriate. But I'm just saying that I think if you want to move it forward in another way like that, you'd have to figure out, you'd have to write a colleague's memo and get the council to agree with you to move forward on that. Which means, that to me seems to be the only way forward on that. Because I've never seen us really hedge stuff like that. So anyway, all in favor? All opposed? I'm going to be less. We'll talk about it. All right, call the roll.
Do you announce the vote?
Yeah, it's 3-1 with Councilmember Tanaka voting no. So
So
we'll have this on the council agenda.
as an action item.
You will waste the council time. We will take this up, and we will have, it really should go on the consent calendar, because you are not achieving anything that's worthwhile at all. All you're doing is delaying, and I gave you a lot of leeway to go through it here, so you'd understand it. If you're just going to vote against this stuff and make the council go through it, I'm not going to let you go through it like this again. I think these committees are the time you talk about this stuff. But I think to put something like this on the council agenda wastes all of council's time and makes it stupid to have these meetings, frankly. We shouldn't have these meetings if we're going to do that.
Well, we could do alternative, which is, let's finish the analysis.
Well, if you can work with staff to do that, fine, but I'm not going to suggest staff does that. I mean, it's not clear to me staff has the ability or the resources, frankly, to do that analysis, and as Monica pointed out, it violates current council policy. So even if you want to do that, there's a whole council policy about whether or not we should do it, and that comes first. And so without doing that and having a discussion at council that says it makes sense to do that, it's really a waste of everyone's time. It's a waste of their time to do the analysis until they actually think, then do we have council direction that we'd be willing to do this? I mean, that's the issue. So all that's going to happen is you're going to bring this to council. People are going to look at each other, talk about it for 10 minutes. You're going to go off on whatever you want to go off on. And then we're going to have this discussion. And then they're going to vote to continue to move forward on this. And you'll have wasted 45 minutes of council time on something that should go on consent. I mean, I can't stop you from voting no, but. All right, you want to do the next item?
All right. Thank you. I see staff is jumping forward to take on the next item. Come on forward, guys. So I'll just do a quick overview of this water leak policy adjustment. Perhaps provide a little bit of context. We do not have a presentation for this one. So just to get the discussion going, the issue we're bringing forward to you is a change to our policy that's really a customer service enhancement. Prior to 2006, we did have a mechanism for making adjustments to individual customer bills based upon water leaks. The policy was changed back in 2006 to address both a period of focus on water conservation as well as a recognition that the prior policy was very difficult to administer. So over the course of the last 12 years, it has been outside the discretion of staff to be able to make any adjustments based upon actual reports of leaks on the customer side. Over the course of the last year, actually more like 6 months, we had requests from customers as well as a discussion at the Utility Advisory Commission to revisit that policy and come up with an alternative means by which we could allow water bill adjustments based upon verified leaks that have occurred on the customer side of the meter. So what we've brought forward is a policy adjustment that would allow us a limited ability to make adjustments in which the utility would share costs based upon overuse by individual customers. Up to $2,500 would be the utility's potential exposure on an individual case. We did receive a couple of questions on two topics. One is the potential overall financial impact that this could have for the utility, and the other is a phase-in, a question of how this might be phased in, whether it be immediately upon the adoption of a resolution by council or if there are some other options. So let me just briefly speak to both of those topics. One, in terms of financial impact, this is really anecdotal because we don't have really solid information on how likely we would, or how many of these would see, but staff estimates anywhere on the order of 10 to potentially as many as 20 cases per year would be an educated guess at what we expect we might see, which again, on an outside, with the $2,500 potential limit, represent about $50,000 per year. There is an option if the council committee and the council wanted to consider capping it at any amount. We could handle it budgetarily. We would show it as a budget line item, and therefore, if we were to exceed, say, again for the sake of discussion, $50,000, that we would require special council action, or we would simply tell customers that we have an annual limit and that anything over that would not be eligible for adjustment. adjustments. So just a couple of things to consider there. And then in terms of phase-in, the way we've structured it, we have been, since we've been tracking this really for the last 6 or 8 months, tracking roughly back since the beginning of the current fiscal year. So we know we have about 8 customer situations in which there were leaks, and so that would be the an option that if the council wanted to backdate this to the beginning of the current fiscal year, 8 would be our guesstimate currently of customers that would be seeking some adjustment based upon this change in policy. Another option would be to have it effective upon the adoption by the council itself, which presumably would be in a few weeks. The one advantage of that would be it's very straightforward, no question as to what rules apply and the date at which this would be phased in. Also would avoid any suggestion that the change in policy was driven by any personal interest, specific interest by any individual customers. Now, on the very extreme, if the council wanted to go retroactive, we do have overall policy related to adjustments that would allow the council to consider adjustments up to 3 years prior. So that would be an option if the committee and the council wanted to go that far back. But again, wanted to just provide those data points for your consideration. And with that, I'll open it for your discussion.
Do we have any public speakers? Okay. Any comments?
Thank you. Just, you're gonna talk, there's another item in here about, what if your meter is running off, right? We're gonna talk about that later? Or should I talk about that now?
We can talk about that now.
Okay. I just had a couple. So on the financial impact thing, sounds like it's likely to be small. In any case, it just seems like the answer is to adjust rates overall, because, I mean, I think what you're talking about here, it might shift the costs around between existing ratepayers, but it doesn't actually raise or lower the costs, so.
That's accurate, yes.
So it seems straightforward that the answer is you would just adjust rates if there's any financial impact.
On that note, I would clarify that the dollar amounts we're talking about are so small relative to overall rates, it's really.
That's what it sounded like,
It would not affect rates.
That's what it sounded like,
On a
right?
median residential bill of $84.72.
Mike?
Apologies. Tom Ozen, Assistant Director for Customer Support Services. Our rate staff estimates the median water residential bill, if this was just applied to residential customers, not across commercial as well, on an $84.72 median bill per month, it would be 8 or 9 cents for $50,000.
My wife would notice, but okay. Okay, thank you very much. I just wonder, if we do an adjustment on a water leak, is there a particular guidance on what the adjustment is supposed to be?
There is, in your packet, among the summary of proposed changes, there's basically 9 bullet items that describes what that policy and process would be. We would sit there and we would benchmark the variance against a period of time in the past. We would sit there and just deal with that variance and apply what's proposed to be up to a $2,500 credit to it. So, and then we would have to verify on the customer's submittal that there was a leak and it was fixed, as opposed to, I don't know where the water went.
Right. I guess I was thinking, so then, this is as simple as if my average water bill is $50 a month, and then I have a leak, and I have a $1,000 bill this month, that you would adjust it back to $50?
Correct.
Okay.
Or we would meet you halfway up to
Okay.
up to that $2,500 cap.
Okay. And I just had one other question. So if your meter is running too fast, and we charged you too much money, then we're going to give you a rebate, but that only goes back to either the age of the meter or 3 years, depending on which is less. I think I saw that in here.
There's a 3-year calendar maximum.
Right.
Or depending upon where we could actually identify.
So we're
where
not
the
going to
problem-
refund you 20 years' worth of
No, but
overages?
in a half a century in the business,
Uh-huh.
I've seen one meter run fast once.
Okay, okay. Actually, because I was really going to ask the other way around, which is, if the meter's running too slow, then does the 3-year limit also apply?
Yes.
Okay.
So we will give you back your money.
But 3 years,
Yeah.
but
Well,
not 20
we-
years worth of?
Let me say this, in a prior policy, depending upon the circumstances, we would go back and try and claw back that money if the meter was running slow, depending upon what the situation was.
So we might try to claw back more than 3 years?
No.
Okay. All right. Thanks.
Greg?
So what is the total downside risk for the city in terms of how much could this cost? Let's say worst case scenario. What is the total cost?
You're acting for a prediction, and I can't give you one. What happens is most leaks occur from irrigation system failures. That happened, it happens at the beginning of the irrigation season. So some people will March, April, May, when it starts warming up. Then when you pressurize your irrigation system, then things blow out of the ground. You lose valves, you lose heads, you lose piping. Because last year was the end of the drought, we anticipate that probably most things that blew up last year. Now, there's going to be wear and tear. There's going to be, entropy continues. But we don't know. But that's the worst case scenario. From my experience, I have to go back to the pre-2006 levels, which was $50,000.
Okay, so your best guess is that this is not going to cost us more than $50,000 to do this program?
I would not anticipate so, no.
Okay, thank you.
So this doesn't really cost us anything. All it's doing is shifting between ratepayers. What you're really saying is if one ratepayer has, an irrigation line break, it costs him $1,000, the rest of the ratepayers pick up the difference in sort of a socialized insurance for everyone. That's really what we're doing here.
Part of it, yes. The part of the problem is that we provide service in advance of payment, and we read meters currently once a month. And so it has happened where we have read the meter, and by our calculation, the next day, something blew out of the ground, and it ran for 33 days. That's the worst case scenario. I mean, that's Murphy's meter. Typically you can't fix what you can't see. And in some cases, people's properties butt up to the creek, and you would expect to see a swimming pool in your backyard with that much loss. But no, it's gone down the creek bed and gone. So how do you know what you don't know?
So this just seems like an issue of fairness to me, about treating our ratepayers fairly by saying if you're unlucky and you have that Murphy's meter, as you said, that you're not stuck with a huge bill which could adversely affect you and really doesn't affect the rest of the ratepayers because it's spread out over so many people. As you say, our rates don't go up because of this or that. So my question was, it was a little unclear to me of what exactly the staff recommendation was. You gave us a bunch of different options of what I heard. So what I was thinking of, what's the way to treat people the fairest? That's really what I had in my mind. It was unclear to me, given the options, what's the downside, the upside, and how do we think about treating people fairly?
Well, in terms of, again, treating people fairly as well as keeping it simple, going forward as recommended without a limit. I mentioned an option of providing an appropriations limit, and if we went beyond that, we'd have to come back for subsequent council action. So simplicity would say, and again, based on experience, we don't see that as a likely scenario. So we can continue to monitor. We will know on an ongoing basis if there are adjustments, and if there were an uptick, we can bring that to the council's attention. So the fairness priority would say, just keep it simple and have it go forward. In terms of the phase-in, given that we know this discussion has been in the public light, that if we were to start this at the beginning of the fiscal year, again, I think that would be fair in that staff has been aware and that the people who are now tracking it in the community would not feel like they got shorted. So beginning at the beginning of the fiscal year.
You'd begin fiscal year, and it would just be unlimited if you, right,
Correct, and monitored by staff.
and monitored by staff.
What kind of outreach are you going to be doing between now and when it starts, just so that the general public knows about this?
Yeah, that's an interesting question. We haven't really talked about that. Quite frankly, I wouldn't expect a great deal of outreach on this. We're not trying to invite people to identify and claim an adjustment. In general, they've come to us. And so clearly, if you get $1,000 bill, you will call the utility and say, something's up. And so we.
No, call me, my phone number's one digit off the utility.
This is true, this is true.
So it's basically just looking at their bills, but would it be something to go out to say, hey, take a look at your pipes, just in case?
And that would be the troubleshooting that staff
Yeah,
does, our customers.
Prevention kind of thing, right?
And we try and do that. At the beginning of the irrigation season, we communicate to people saying, go out, turn it on, check, make sure that things haven't.
No
gone-
geysers. Right.
There's no geysers. Look behind the bush, because.
And if you're
sometimes
against the
behind
creek,
Because, my experience is not really geysers, it's this little hole in the pipe, and it's a really slow one, and then all of a sudden there's a swimming pool. But that's taken days for it to happen, it's this tiny little spring. One more question. So this is the residential program, is there such a thing for the commercial side?
This would apply to the commercial as well.
Oh,
They
okay.
have the same issues. As a matter of fact.
Right.
Of
They're bigger.
the customers that we're working with now, one of them is a commercial customer.
Okay, thank you.
All right, Greg?
So just out of curiosity, when I was asking about the total cost, I went actually the total cost to the ratepayers, not just, because I'm thinking of myself as a ratepayer. So, so $50,000, what you think the total cost is, not just the cost of the city? Because I know what
Correct.
the chair is saying. So you meant $50,000 is what your estimate is, the cost.
Correct.
Okay, okay, I just want to make sure I understood that correctly. It's not the cost to the city, it's the cost that the ratepayers would bear.
Correct.
Okay,
other than, well, the individual ratepayer potentially would have individual ratepayers another 50, since we're picking up half.
Okay. I'll move the staff recommendation that we keep it simple.
Second.
And the rest of it would be that we do this on an unlimited basis, right?
Yes.
All right, any other firm comments? All in favor? All right, anything else?
Thank you.
With that, normally we talk about future meetings, so,
We're on track for our next meeting on March 20th to discuss infrastructure and pension, and at your last meeting, you had given us some direction to prepare for that, so we've been working on that.
Right.
And you had also given us direction to begin looking into scheduling for May budget hearings, and staff is working on that calendaring as well.
okay, great. All right, well, thank you.
we have a meeting on March 5th?
You know?
No, that was canceled.
So we
The
canceled the
March
meeting.
6th meeting was canceled.
Okay, great.
Yes, so our next meeting is March 20th.
Oh, wait, yes,
May I address future planning and very oral non-agenda? Excuse me.
Can you use the microphone, please? Thank you. Say your name for our viewers.
Nielsen Buchanan, 155 Bryant Street. One of my concerns, having been overly immersed with parking issues for God knows too long now, is that now we recognize there is a pattern between the aspirational and reality. That during this course, we've all learned about things what we can fix, and there's mitigations, and there's programs, and I can on one hand, I understand the budgetary constraints, and that you put things in the hopper and you hope they get funded. But when we look back at the history of the so-called promises or intents, aspirations of ways to mitigate parking in the neighborhoods, many of the programs, particularly those on mitigation, have been purely aspirational, and some of them remain that way. So what I'm wondering is, how does the public interface with things that never get done that are material to moving permit parking forward. It's just not the University Avenue downtown permit program, but now those interventions and mitigations now applicable to all over the place. For example, we've come to the realization, and thank goodness to the very honest, capable permit parking guys, two of them, is that the management system that we've been counting on is kaput. In fact, it's just worthless. We suspected that back when I was with the stakeholders group, that this looked like it was pretty shallow, but what did we know? And what we're getting wind of as we bring permit parking forward just next Monday, that the next couple of years then is dependent upon a whole bunch of stuff that we hear staff talking about, but we don't understand how it gets plugged into the budgets. So it is a little bit of micromanagement, but it's part of the 10-year, 12-year kicking the can down the road thing. We never get to certain places because certain programs, almost programmatically, don't get funded. So I can be more specific because I'm just beginning to deal with the so-called renewal of the permit parking program for downtown, and we have been in utter shock for a little over 4 or 5 days to hear that the staff recommendation is to continue the program that's been put forward with no change, when in fact parking has dropped, permit sales, non-resident permit have dropped to 1,000 or 1,100, yet the city wants to continue the maximum permit sales around 1,400 to 1,500. That's a separate problem in itself. But underlying all that is what I know is then the road to hell is paved with great intentions, and I think staff really does have good intentions. But if all the little things aren't funded, we're going to be talking about kicking the can forever. And what I'd like to do is work with staff some sort of way, so here are sort of line item concerns. We are hoping this is all going to fall into place in your process that I've heard too well, of how these things are going to get funded, because if they're not funded, it's a joke. The permit program is going to just, will never contain the flow of parking into the neighborhoods. Pricing, TMA, all those things are beginning to happen, but there's a big item coming up, as I understand it, for this, casting out the permit parking management system, enforcement and all that, not only for downtown neighborhoods, but for the core too. Because I realize if that's not funded, we're going to be floundering in a most serious state. So excuse me for getting you down to the details. I just want to make a public statement that what's really hanging us up as we go into Monday night is do we have confidence in our city government to make these things happen? And I do want to defend, start and finish, the two young guys that are taking over the permit parking. They've moved the ball better than anybody so far. So it's not a criticism to the people. It's to maybe people up a little bit.
Thank you. All right, meeting adjourned.